Well, let's see if the battery lasts a little bit longer. Sorry about that. But anyway, what we're going to get into basically are convertible bonds, convertible preferred stock. We're going to get into stock warrants, stock options, and some pretty interesting stuff, really. I think you'll find it fairly interesting. Okay, the first creature we're going to look at is convertible bonds. We've learned about bonds. We know about bonds. And if I issue a bond that's convertible, I do that for several reasons. One reason is I can issue convertible bonds at a lower interest rate because those convertible bonds can be turned in for common stock. That's why they're called convertible. Questions on that? Now you buy a bond and that means you get the interest as normal, and then if the common stock does really well, I can bring that bond in and trade it in for common stock. So look at what happens. Look at this. Look up here. When somebody brings in a convertible bond and trades it in for common stock, they're no longer bondholders. So whatever is up here for those bonds in our liability section, whether it's a discount, whether it's a premium, we bring that carrying value down to stockholders' equity. Okay? So we're going to grab the carrying value and we're going to make our journal entry and we're going to bring them down to be shareholders. But convertible debt is issued because you can do it for lower interest rates and you're not going to dilute your control as quickly. The only thing you have to remember about issuing convertible bonds is that you issue them just like they're regular bonds. Everybody got that? You issue them like they're regular bonds. Now there's some discussion about that. Some people think that part of the issue price should be allocated to stockholders' equity and part should be debt. And they're going back and forth on that. But right now, you do not allocate any of that you don't allocate any of it to common stock. Now when it is converted, if it's ever converted, then we'll bring it down and make it part of stockholders' equity. So you can see it says, at the date of it is issued, you treat it just like regular debt. That's all you got to remember. Now when people bring the bonds in, picture somebody walking through that door and they're saying, here are my bonds, I want to trade them in for common stock. Here you go, here's my bond. Give me some stock. They're not giving you any more money. So your accounting equation as far as assets go doesn't change. They don't give you any more money. So all we're going to do is to take everything from up here that relates to the bonds that are converted and bring it down here. So here's our journal entry. We take the carrying value of the bond. In this case, it was a premium. So we're going to debit the bonds payable to reduce it. We're going to debit the premium that's left on this one bond to reduce it to zero. And we bring that down to common stock. So don't get tricked by the problem might give you the market value of the common stock or the market value of the bonds. It doesn't matter. Doesn't matter. Doesn't matter. We use whatever the carrying value is and bring it down here just like this. Even though it may tell us what the fair value is, it doesn't matter. This is the book value. We're taking the book value and bringing it down to common stock. Because that person turned that bond in, they're no longer a bondholder. They are a stockholder. Questions on that? They are no longer a bondholder. They are a stockholder. Now the company, the bonds that are convertible, the company cannot force them to bring them in. But they will normally bring them in when it's to their advantage, when the common stock does really well and goes up. Oh, I'm going to trade these in for common stock. Common stock's doing great. Or it's going to do great. So the company can't force them to do that. Because we're assuming these bonds are not callable. A callable bond means that they can force you to bring them in. But we're assuming these are only convertible, not callable. So the company might have to sweeten the pot And they might have to induce them to convert because we can't force them to unless we hold a gun to their head or something. So this company paid $80,000 to induce the bondholders, the convertible bondholders, to please bring these in. We're going to pay you an extra $80,000, and notice that that's expensed in the year that it happens. Some people think that that should reduce the equity, but as of right now, FASB says, no, we're paying for a service in the year that it happened. We're paying for them to bring the bonds in and convert them. So whenever that happens, we're going to credit cash and debit bond conversion expense. It's not amortized. Because usually we think anything to do with bonds has to be amortized, right? But it's not. In this case, it's expensed as incurred. So we credit cash and debit the bond conversion expense. And this bond was issued at par value. There was not a premium or discount. So we just take the carrying value and bring it down to our common stock. Common stock is credited for the par value. The rest gets in the additional paid-in capital bucket. So we bring it from the liabilities to stockholders' equity. So questions on when bonds are converted. Convertible bonds are issued just like straight debt, and when they're converted, we go from liability to stockholders' equity. Well, what about convertible preferred stock? Wow, there's such a crazy thing. Yes. Preferred stock may be convertible. Preferred stock may be convertible. The company cannot force them to convert that. But, so anytime the word convertible is used with a security, the person who owns the preferred stock or the bond, they have the choice to redeem, to convert them or not. The company does not decide that. Everybody understand that? When it's a callable bond, the company decides when to call it in. So in this case, somebody brought in some preferred stock. They said, here's my preferred, give me some common based on the agreed upon ratio. And so we give them common stock based on the ratio here. So again, all we have to do, this is the book value, there's no going to be any gain or loss, that the common stock had a par value of $2,000. This is pretty unusual. The common stock, we're going to give them 1,000 shares, the par value is $2. And that's greater than the carrying value of the preferred stock, so the rest of it has to go and pay retained earnings, or we take it out of retained earnings. So this is almost like a loss, even though remember, never ever ever recognize a gain or loss when you're dealing with your own stock. Never ever. So instead of having a gain or loss on the income statement, we go to retained earnings. We bypass the income statement. So the par value was $2,000 altogether, and that happened to be greater than the carrying value of the preferred, so the rest of it has to go out of retained earnings. The rationale for the debit to retained earnings is that Host has offered the preferred stockholders an additional return to facilitate their conversion to common stock. Many states require the charge simply reduce retained additional paid-in capital, but don't worry about that. It comes out of retained earnings. So, when it's convertible bonds, when people convert their bonds, again, we bring the carrying value down here. When it's convertible preferred, we bring the carrying value down here because they're converting them to common. They're converting them to common. Questions on that? Think through that. Okay, stock warrants are a big deal these days. Not as big as it was, but it's still a pretty big deal. Okay, picture stock warrants as a piece of paper. Just a piece of paper. They're certificates. If you're a current stockholder of a company and they issue new stock, one of the characteristics of common stock in the United States and really around the world is that you as a current stockholder have the preemptive right. You have the right of first refusal. Because if you own 10% of a company and they issue new stock, you may want to keep your same control. You want to control 10% of the stock. But if they go issue a bunch of new stock to a bunch of new people, you might lose your 10% control. So you get the right of first refusal, you get that preemptive right. You get the right to buy 10% of the new stock. And they may give you a stock warrant for this. that stock warrant usually does not have a very long life. They usually maybe 6 months, and you have 6 months to buy that stock or something like that. And there's a strike price on there. There's a determined price that you get to pay for it. And usually it's a little bit less than market value. Not a whole lot less, but a little bit less. Okay? Another reason to issue stock warrants is that you might issue a bond. You might issue a bond and give a stock warrant on top, and they're called detachable stock warrants. So picture a piece of paper and the top of it's perforated, even though it's not the way it is, it's good to visualize that. You rip it off and say, oh, I can buy 1 share of stock for $15, here you go. So you separate it from the security, and that makes that bond more attractive. And I might be able to issue that bond at a lower interest rate because I'm giving a stock warrant. And usually if you have 1 stock warrant, that allows you to buy 1 share of stock at a little lower rate than market value. There's a price on there, okay? Now, a stock warrant attached to a bond is not the same thing as convertible. It's not a convertible bond. Remember, when a convertible bond is brought in, you trade it for common stock and give the bond over, right? That bond doesn't exist anymore. But when I give a stock warrant on a bond, I rip that stock warrant off, and that stock warrant has a life of its own. You can buy and sell stock warrants. Some of them have, their life can be a few years, so they have some value. Because if the price of that stock warrant that you can buy the stock for gets above that, it's pretty valuable. But when it's a stock warrant on a bond, it wouldn't be a convertible bond. You can't have a convertible bond and well, normally you wouldn't have a convertible bond and have a stock warrant on it. But when somebody rips that warrant off of the bond and brings it in, they get to keep their bond. And when they bring in that stock warrant, they've got to give me cash for the stock. And that increases my assets, right? You see the difference? A convertible bond, they just bring the bond in and trade it for stock. No assets are affected. But when it's a stock warrant, they rip it off and bring that stock warrant in and give me $20, and I give them a share of stock. So that increases my asset. I already mentioned the preemptive right. Companies give warrants, often referred to as stock options, to executives and employees as a form of compensation. So a stock warrant is a type of stock option. A stock warrant is a stock option, basically. You hear a lot about stock options. All right, now, whenever you issue a stock warrant with another security, you're trying to make your preferred stock more attractive. You're trying to make a bond more attractive. You may issue it with the stock warrant. Well, FASB says this is different than a convertible bond. A convertible bond, we don't split that one up, but we do split it up when there's a detachable warrant. We have to allocate some of the issue price to equity and most of it to the liability when it's a bond. There are 2 methods here, proportional and incremental. Proportional is used when you know both the fair market value of both of them. And let's take a look at this. The proportional method can only be used when you know the fair market value of the stock warrants and the fair market value of the security without the warrants. So we're going to do a little ratio action here. At one time, AT&T issued bonds with detachable 5-year warrants to buy 1 share of stock. Par value is $5 or $25. So they can rip that off and use it separately. We can sell it separately, or we can keep it and exercise it. We can keep it and exercise it. At the time, a share of AT&T stock was selling for $50. So look at this. I can buy 1 share of stock for $25, and it's selling for $50 today. That has value immediately, doesn't it? I can take this warrant in and say, give me a share for $25, and I can go sell it for $50 on the same day. So that has value right there. These warrants enable AT&T to price its bond offering at par with an 8.75% yield, which is lower than the prevailing rates. If they didn't have this detachable warrant, they would have to pay a much higher rate of interest. So they got to issue their bond at a low rate of interest, which is really important when you're issuing hundreds of millions of dollars of bonds. Your interest is very high. To account for the proceeds of this offering, AT&T would place a value on the 2 securities, the value of the bonds without the warrants and the value of the warrants. so they can use the proportional method. Okay, the price paid for $1,000 bonds with the warrants, we were able to issue those at par for $10 million. So here's your proportional method. The fair value of the bonds without the warrants was we could sell them at 99. Now, how do we know that? Well, people in this field, investment bankers, they're very knowledgeable and they know these kind of things. So if we didn't have that warrant attached, we could not issue them at par at 8.75%. We would have to have a higher rate. But we were able to issue them at 8.75% because we gave them a warrant. Well, if we didn't give that warrant, we'd have to sell them at a discount to effectively yield that higher rate. Hopefully that's making sense now. We would have to have issued those at a discount to get that higher rate. So anyway, 99 to 9.9, the fair value of the warrants was $30 a piece, 300,000, so the aggregate fair value was 10.2. But you see, we only got $10 million. So we only got $10 million. So we take our 9.9 million, divide by 10.2, that gives us our percentage, times 10 million, so that amount is allocated to the bonds, and our other percentage is allocated to the stock units, for a total allocation of 10. See how that ratio works? We could have made this entry together, but it's good to see it separately. So, you know how to do this right here. Bonds payable is 10 million. Remember, you always credit bonds payable for the face value because we agreed to pay that in however many years. Our discount and our cash. Questions on this entry? Okay. Now, we also, because FASB says people are buying these bonds and giving you par because they put value on those stock warrants. So we want you as a company to also put value on those stock warrants. So you're going to debit cash for $294,118 and credit paid-in capital stock warrants. So there's a new paid-in capital account in stockholders' equity. That's a new paid-in capital account in stockholders' equity. And then you would amortize this bond as we learned. So, you know, it has a discount, we would amortize it to interest expense. But now this is a little different. Okay? Remember that when somebody brings in a warrant and lays it down in front of you, they still got to write you a check. They've still got to give you cash, right? They've still got to give you cash. And usually that cash is less than the market value, but you had an agreed upon price. On that stock warrant it says, okay, this is for 5 years, and you can buy stock for $25 or whatever it is. So they bring it in. So when they brought all these warrants in, we're assuming they all brought them in at the same time, which is a big assumption, but they've still got to give us $25. So we're going to take that and put it in our cash account. We had to issue 10,000 shares, and that's our $5 par value, right? The only thing you put in common stock is the par stated value normally. Paid-in capital in excess of par gets the rest of it. Well, where did the rest of that come from? Well, you know, only gave us $250. Remember, this is in an account, so picture this sitting in a T account in stockholders' equity in the general ledger. Well, we're going to reach over there and grab that and make it part of this issue. Because we received that cash in the past, didn't we? We received that cash right here in the past, and now people have exercised it. People have exercised their right, and they brought us more cash, so that represents cash we received months ago. But we put that in a paid-in capital stock warrants account, and picture yourself reaching over there and grabbing it and including it as part of this conversion. Now, what about if they would have only exercised 5,000 of them? Well, this would be 5,000 times 25, this would be 5,000 times 5, and this would only be half of this, wouldn't it? Well, what about if the rest of them are never exercised? You know, they don't have to be exercised. You can't require people to exercise them, and some of them don't get exercised, okay? Well, when that's the case, what we do, and it tells you right here, whatever's left in this account after they expire, because they have a life, they have an expired life, whatever's left in that account, you debit and credit paid-in capital expired stock warrants. And that becomes a permanent account in your stockholders' equity. It expired, and we're going to keep it. We're not going to give it back to them. So we take it, whatever's left in that account after the time passes, we take it out and transfer it to paid-in capital expired stock options. And it stays there pretty much forever. Pretty much forever. So you see the journal entry. When you issue stock with or we issue a bond, in this case with a detachable warrant, we have to allocate value to both. So we went through that, we issued, that's our bond, and that's the paid-in capital stock warrants. So when they actually exercise the stock warrants, we grab that 294,118 and bring it over here and use it as part of this entry. Well, what about if we don't know the fair market value for both of them? Well, then you have to estimate the fair market value for at least one of them, and in this case, we felt like the warrant had a better fair market value. So we received $10 million. The warrants had a $300,000 fair market value, so the balance is going to be allocated to the bonds. So the incremental approach is when you only know the fair market value of one of them. So that gets allocated to the one you know, the rest gets thrown in the other one. Make sure you read through all this good stuff here. Two separate ones. There's also a thing called a stock right. Companies can give a stock warrant when they issue new stock. They can give a stock warrant, and you can use that to buy the new stock. They can also issue a stock right. And a stock right is kind of the same thing. Basically, it gives you the right to buy a certain number of shares at agreed upon price. But the life of it's usually very, very small. The life is not nearly as long as when a warrant is used. But the point is, the certificate representing the stock right states the number of shares the holder of the right may purchase. Each share of stock owned ordinarily gives the owner about one share of stock. You don't make any journal entries when you have a stock right, because nothing has happened really. You just give people the right to do it, and then if they use the stock right, they bring it in, give you a check, and buy the stock just like anybody else. So we just make a memo entry. Now, a memo entry is not a debit or credit. We use that word a lot in accounting. Just make a memo entry. What in the world? Well, you don't debit or credit anything, but you make a note basically and put it in the file or put it in your computer that this happened. And this would be on the board of directors minutes, and it would be probably several places this memo entry would be made, but it's not a debit or credit. It doesn't hit the books as a debit or credit. So, questions on convertible bonds, convertible preferred, stock warrants, stock options, stock rights? I really want you to get that when somebody converts a bond or converts a preferred stock, there's no additional cash. But if somebody uses a stock warrant or a stock right, there is additional cash. And if you have paid-in capital from stock warrants and they exercise that warrant, you grab that amount and make it part of the stock issue. Okay, stock compensation plans. You've heard of stock options. You hear the stories about, I think Michael Eisner, he used to be the head of Disney, he still may be, but anyway, 1 year he cashed in like $250 million of stock options. So the way a stock option works is, you have the right to buy one share of stock at a certain amount, okay? So let's say you go to work somewhere, and the manager calls you back there and says, hey, welcome. We expect great things out of you. You're the best accountant, we expect you to be the best accountant ever. So we're going to give you some stock options today. We're going to give you 1,000 stock options. And these are your stock options. Now, you can buy 1,000 shares of our stock at $20 a share. Oh, but you can't use them for 5 years. You can't use them until you vest. So that vesting period is your service period. Okay? You You can't use them for 5 years. So if you leave before 5 years, or you get fired before 5 years, oh well. No, no harm, I guess. You just don't get to use them. So you go back to your office. Hopefully it's an office, not a cubicle, but cubicles are okay. And you go, wow, $20? Let's see what the stock's selling for today. And you look up Yahoo or whatever. It's selling for $5. So what they want you to do is to work and work and work and work hard and help get the value of that stock up from $5 to above $20, right? Because if you can get it from 5 to 30, everybody benefits, right? All the current stockholders, all the future stockholders. So they want you to work hard and help get the value of that stock up. Well, what about if you don't get it up? Well, nothing happens. You just don't get to use your stock option. Because you would never use that stock option unless the value got above $20, right? If the value gets up to 25 and you're vested, you can buy for 20 and sell for 25. And then you got some tax issues, but we're not worried about tax issues. So that's the point of a stock option. You get mostly executive stock options, so they will create value in that company, get the earnings per share up, get the stock value up, and everybody benefits. But as you read through this chapter, it's going to tell you that a lot of companies have started getting away from stock options because it does produce an environment where a lot of fraud is committed, because they want to get that market value up regardless, and that's where fraud might rear its ugly head, because they want to get it up so bad so they can cash out and make tens of millions of dollars. So they went to granting, it's not called stock options, it's granting stock. So what that means is, if you went back there on the same day you started and they said, hey, here's 1,000 shares. I just started today and you're giving me 1,000 shares? Well, yeah, but read the fine print. You cannot sell that stock till you vest in 5 years. Usually they would, the stock options are always usually a lot greater than how many shares for granted stock. So those are restricted stock. It's restricted. They actually give you the stock, but you can't do anything with it for a certain number of years. Well, what about if you leave before that vesting period stops? Well, you got to get the stock back. You can't sell it until you vest. And that's your service period. 5 years is your service period, or 2 years is your service period. And that's how we allocate the expense over. That's where we allocate the expense over. And you can see the companies are getting away from the options. Disney is, $120 million. I don't know what year this was, 2011 maybe. But anyway, they're doing much more in fair value restricted stock grants. That's what I was talking about. They give you the stock, but you can't do anything with it for 5 years till you vest. So you can see that the numbers are going way up for the stock grants, because it doesn't really create that same environment, that same pressure. Even though there is some pressure, you can still commit fraud, but not as much. Okay. On the date of grant, is there a value? So when I receive a stock option, that's what we're going to do first. When I receive a stock option, is there any value to it? Because the market value is $5, and it's got to get up to 20 before it's any good. But there's a 5-year vesting period. Yes, there is value to it. The intrinsic value would be 0. The intrinsic value is 0 anytime the purchase price is greater than the market price. Because on that stock warrant or stock option, it says how much you can buy it for. Anytime that's greater than the market, nobody'd use it, right? You wouldn't have a brain if you used it. So the intrinsic value is 0. So, on the date of grant, you look at the difference between the market value and the purchase price, and if they're the same, the intrinsic value is 0. I'm not going to go into the history of stock options right now, but we don't use that method anymore. It used to be that when companies issued stock options, they used this method, but guess what? On that date, it was always the same. When they granted the stock options, the intrinsic value was 0, so they didn't have to record any compensation expense. And there was a big battle about that for years. Well, now we have to use the fair value method. So we plug all these variables into this options model. Most people use the Black-Scholes model. I think that's the name of it. You know, it's a big computer program. You throw inflation, you throw the interest-free rate of interest in it, the volatility of this stock. They throw all these variables in there and do all their things, and it out pops the fair market value. Is it always perfect? No, it's probably rarely perfect. But it gives you the value of those stock options that you have granted, magically. It gives you a number, spits it out, jumps out at you. They throw all those variables in there. So we have the easy part. The entries are pretty simple. We have to determine the fair value number, which I just described on the date of grant, the grant date. We have to allocate the expense over the service period. And then when they bring them in and exercise them, we have to make an entry. But they're not hard, don't miss these. On the date of grant, no entry. Because they haven't given us any money. Nothing's really happened. But you do record it. A memo entry. No debits, no credits. Okay, at the end of our fiscal year 2014, they said the fair market value was $220 when this option pricing, the grants were given on this date. They threw all the variables in the option pricing model and spit out $220. So we have to allocate that over the service period for proper matching of revenue and expenses. We want these executives to work hard and everybody will benefit. So we're going to take this $220, and it's a 2-year service period in this case, before they vest. The service period and the vesting is the same. You got that? The service period and the vesting period are the same. So we have to allocate that over the service period. So we're going to debit compensation expense and credit paid in capital stock options at the end of 14, at the end of 15. If it was a 3-year service period, we would divide this by 3, and we would make 3 entries. We're allocating our compensation expense over the service period. Okay, well what about when they exercise these? I'm glad you asked. Okay, remember, they walk through that door and they bring in these stock options and lay them down and say, hey, I'm ready. Oh, well, did you bring your checkbook? Remember, when there's a stock option involved, they've still got to give you money, right? So they get their checkbook out and write you a check for the stock. But it's much less than the market value, most likely. They would not exercise those options unless the market value is greater than the purchase price, right? That's very important to get. Very important to get. So they bring in their cash. This person's, somebody's exercising 2,000 of the stock options. So they have to bring in $60. That was the purchase price. So they're going to give us a check for $120,000. We're going to credit common stock for the par value. And then we're going to reach over to that newly created paid-in capital stock option account that has a credit balance. It's a stockholder's equity account, right? That's a credit balance. And we're going to grab 20% of it. And we're going to use that for this exercise. Questions on that? So you have to worry about, is it a percentage? If they would have exercised all of them, we would have taken the whole 220 here, wouldn't we? And this would have been 10,000. It would have been, $600,000. So you got to get in the mindset where when you do these, you've been adding things to stockholders' equity. So when people exercise these, you got to remember to go over and get those numbers and bring them. And bring it and make it part of it. Well, what about if they fail to exercise any of these? Now, this is really important, as everything is. If somebody vests and fulfills their service period, and they do not exercise their stock options, maybe they just didn't have the money. Maybe they don't think it's a good thing. You still wouldn't go back and fix compensation expense. They still earned it, so you leave it alone. You don't go back and change it. But what about if they leave or get fired during their vesting period? That's a different story. If they leave or get fired during this vesting period, they don't get these stock options. They don't get to use them. So we have to adjust their, that's down there below, we have to adjust our compensation expense. So we look at the total for that person that got canned because of whatever reason, or they left, they got a better offer. We look at the amount of compensation expense we've accumulated over the years, and we have to credit compensation expense in the current period for that. It was not good matching, but that's all we do. It's a change in estimate. However, if an employee forfeits a stock option because they fail to satisfy the service requirement, the company should adjust the estimate of compensation expense. The company records this change in estimate by debiting paid-in capital stock options and crediting compensation expense for the cumulative amount for this person. So if they fulfill it and they just don't use them, this is the entry, right? You transfer to expired stock options. But if they leave, they don't satisfy their service requirements, we have to debit paid-in capital stock options and credit compensation expense for the total that we debited for compensation expense for that. So stock options are kind of interesting. Make sure you study those, even though that's not part of your exercises. Make sure you study those. Sorry about taking so long to get this back. I know it's, we took the test over a 2-day period and all that. Carter, here's yours. Multiple choice worth a 1.5 apiece, so there's 30 points. Some of you really struggled. Some of you did okay on them. Some of you really struggled. If you want to make notes to the side, please do. And I'll be glad to go over those with you. But let's take a look at a couple of the problems on the premiums. I think this was worth 10 points. I think it was worth 10 points. Anyway, you buy the premiums. Most of you got that. Most of you got the sales revenue. That's cool. But those entries weren't worth a whole lot because it's pretty straightforward. But the premium expense is what we were after here. There was 2.8 million, and there takes 10. We took 10 coupons or box tops, whatever it was, to get one. So there's 280,000. And basically, people are going to send us. It cost us $2. I think they're going to send us $1.20. So they're going to send us 224,000. Oh, we netted that out. That's right. Some of it was postage, and this person netted it out, basically. So they're going to send us 224,000. So anytime somebody sends us money, that reduces our expense. Does that make sense? And then the premium expense is going to be the difference between what the inventory cost us. The inventory cost us $1.50 or $1.80, whatever that is. 280 times $1.80 is 504. And so that we take that out of our inventory, and that's our premium expense. And then this entry, a lot of you put 400,000 here, I think. But anyway, there's 2 million left. I only had you do 2012, right? I only had you do 2000. Only had you do 1 year. And so I didn't take off a lot as long as you got the journal entry right. But there was 2 million to be redeemed in 2013, the next year. So 2 million divided by 10, and it was going to net out. It cost us $1 because they send us $2, and the purchase price is $1.80, and it takes $1.20 to mail, so that's $3 total cost. But they send us $2, so it nets out to $1 basically. Questions on that? And there was 200,000 left because of the 2 million. A couple of you really struggled on the payroll entries. I didn't mean for this to be real complicated. I mean, I wanted to challenge you, but I didn't want it to be this complicated. I know reading the ceilings and all that's kind of difficult. So anyway, you had 1,840,000, 320 represents amounts paid in excess of 106.8, so that tells you something about the ceiling we'll talk about in a second. The amount paid to employees in excess of 7, which you know that's state and federal unemployment, was 1,440,000. So that means federal unemployment would be on the difference here. The amount paid to employees in excess of 7, you know in excess wouldn't happen. So that basically means 400,000 will be subject to state and federal unemployment. State income taxes were 450, income taxes withheld, I'm sorry, was 450, so that tells you what was withheld. The state unemployment tax is 1.2%, the federal unemployment tax is 0.8%, and FICA is at 7.65, up to 106.8, 1.45. So anyway, blah, 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 it's a mouthful. So basically, you take your 1,840,000 less 320, and that would give you the full. That would give you the full 7.65, and then 320,000 is above that, so that's the 1.45%, which is Medicare, and so 129.20 would be our FICA taxes payable. And I didn't take off much if I just missed a calculation. But the gross pay, less your deductions, gives you your cash. A couple of you included federal and state here. Federal and state is just part of your payroll tax, right? Federal and state is just part of your payroll tax. So, keep that in mind as you go forward. And your payroll tax expense, you've already got your FICA, so you just reach up there and grab that. And then FUTA was 1.2%, and then you got your state unemployment tax. And some of you did made the other entry to pay him. I didn't ask for that, but it was nice of you. So if I ask you what the total expense was for this payroll, I didn't. It would be your salary and wage expense plus your payroll tax expense. Questions on payroll? Most of you got this one. I was disappointed. A couple of you had a premium. But you know that the contract rate is less than the market rate, so it would be a discount. And that's a lovely amortization schedule there. So you take the present value of the lump sum using the market rate, the present value of your interest using the market rate. And you should have came out with $3,542,000. And there's your chart. And I asked you to make a couple entries for the year. Moving on to troubled debt restructuring. Basically, I think some of you got the books mixed up, which is easy to do, but if they were right and you just got them mixed up, I think I just took off a point. This whole thing was worth 8 points, so if you didn't get it right, it didn't kill you completely. But anyway, Ludwig's books, they're the person who owed the note, so they got a real deal. Their note's payable 0 now. They had a gain on the land. We had to revalue the land. There was a $408,000